Hi everyone. Welcome to pipsedge.com. Today we will understand how interest rates differences affect the Forex pairs. Before getting into details, please read the disclaimer. I am not a financial advisor and anything mentioned on this channel is not financial advice. The economy cycle. A country's economy may be expanding or contracting. In developing economies, GDP growth positive, consumers earn more, causing them to spend more. The result is that there is more money to buy fewer goods. This triggers inflation. Inflation is inevitable for any growing economy. However, too much unchecked inflation harms the economy. Hence, central banks around the world use such indicators as PCE and CPI to monitor inflation levels in their respective countries closely. To maintain comfortable inflation levels, about 2%, a central bank may increase interest rates. Higher rates bring down inflation, discourage borrowing, and slow economic growth in a country. What is interest rate? An interest rate is an amount charged for a loan. Currency markets are affected by sovereign interest rates. Countries need capital to run. Sometimes, they get this capital by issuing loans in the form of bonds. The interest rates charged for this kind of loans is referred to as the sovereign interest rate. How do interest rates affect currency? Global investors will generally pour their money into countries with high rates, hoping to get a piece of the return. If the rates are low, investors will generally choose to take their money elsewhere. Therefore, higher interest rates will attract global funds into a country. Conversely, low interest rates drive global funds away from a country. The net effect is that a currency will strengthen if the country's interest rates are high. A currency surrounded by low interest rates is, on the other hand, more likely to weaken over time. Interest rate predictions. Like any other market, the Forex market is ever changing. Likewise, interest rates fluctuate, but they don't shift as often. It's also easy for the market to price the current interest rates into the currency prices. However, market expectations on the slope and direction of interest rate changes shift on a week-to-week basis. The interest rate differential. How can a Forex trader find out whether a currency will strengthen or weaken over time? They may consider the difference between one currency's interest rates and that of another. This difference between two currencies is the interest rate differential. The interest rate differential can help you identify shifts in currencies that aren't so obvious. Generally, if the interest rate differential is rising between two currencies, the higher yielding currency is growing stronger. A narrowing differential is, however, positive for a lower yielding currency. Pick a currency pair, any pair. In carry trading, a trader picks a high interest rate currency and pairs it with one with a low interest rate. The trader then holds this currency pair for the currency that pays more interest. By using rollover, the trader will receive daily payments based on the interest rate differential. When you trade, sell or purchase a currency pair, you will be buying one currency while simultaneously selling the other currency. Your trade may be settled within 2 business days. This is called a spot market transaction. You may also choose to hold your currency transaction for longer than 2 business days, in which case you will be entering into what is known as a forward trade. So, what's the take-home message here? A Forex trader must look at the full picture. After all, trading is just but a game of relation. So, know the country you are pairing a currency against. Understand how it's doing economically. Consider whether it's raising or lowering its interest rates. If you can understand how each currency is moving in terms of currency interest rates, you are okay to make a trade. That's about it for today. See you tomorrow. Until then, have a great week ahead and happy trading.